Okay, so welcome back in this new video. This is another of the very important video I'm going to do on this YouTube channel. And yeah, this one basically is portfolio analysis. And I'm going to show you many things since recently I received a bigger amount of capital under management, around 300,000, and then following another 100,000. So in total now is like 600,000 USD. So yeah, I decided to put more effort in everything I'm doing. And yeah, basically I'll show you how I improved this portfolio. So now you can see the equity line, but I'm going to show you everything later. Basically, this one was my previous portfolio, the portfolio I'm using now. It has like a good return on drawdown ratio, drawdown, and of course like other metrics. Now you see like a really low share ratio because of the big amount of trades, but you have to think about that around 6,000 trades with a profit factor of 1.5. This is like a good performance. This is something that is statistically significant, okay, compared to someone that in 8 years had 300 trades with a huge profit factor. This is not something statistically significant, okay? So yeah, this was the first portfolio. This is like the portfolio that made me in 2025 27%. So yeah, but recently I add three different mean reverse strategy, and so as you can see, the magic of diversification with uncorrelated logics, uncorrelated strategies. As you can see, the main things you have to focus on drawdown, and as you can see from, let's say, the drawdown still is the same, okay, of course, but and you can say why so it's the same, where is the point on doing that, okay? But the thing is, the return on drawdown ratio from 46, it went up to 72.6, okay? So the total profit, it increased by like 80,000 USD, okay? Just adding those three strategy, okay? Because all of them were mean reverse, okay? And as you can see, those are still the same logics. The one I add are this one, gold MR, and then US 100 MR, and then this one. And those are mean reverse. MRs is, it means that, okay? So basically, the goal now is not to increase the profit. I'm not going to add all of those strategies without reducing the risk. My goal is to keep the same amount of profit, okay? Because now I don't really care about this type of profit here, because you should only focus on have more asset under management, so managing more money overall, okay? So you don't really have to care about how much total profit you're going to make, okay? You just need to focus on the return on drawdown ratio. And basically, the main goal is reached, okay? Because I increased the return on drawdown ratio, kept my risk the same. That's the main goal, okay? Keeping the same return, even more in this case. So yeah, this is like amazing stuff. And guys, trust me, this is like the holy grail in investing and trading, is like having uncorrelated strategies, uncorrelated logics all together, because they are going to reduce the performance fluctuation, performance movement, okay? As you can see, all of them are moving not in the same, of course, same direction, because all of them make money. But if you can see, this one is like dropping and the other one is making money. And yeah, it's like, this is uncorrelated strategies, the logic behind that. So basically, this is like the same balance curve. This is not equity, this is a balance curve. It's built a little different, but basically it's the same. But actually here, if you, this is like with 100,000 euro, you already see that like in 2 months, you went up to 5K and then dropped to 2,500. Okay, so you lost like in just 1 month to 2,500 euro. Okay, you could say, oh, whoa, it's not that smooth anymore. Okay, but actually it is. I'm also showing you all of this type of analysis, okay, because I really think that you have to understand that with manual trading, you cannot beat the markets. Okay, just if you think that I never seen this type of analysis on YouTube, okay, so I'm really happy to show and share all these type of logics, okay, on just not just logics but also showing you like how you can analyze or how you can think outside of the box, not just doing backtesting. Backtesting is, I think, 20% of the process. Okay, you have something that work. Whoa, that's great, but it's not that much. Okay, it's easy finding something that work. Then you have to find at least like 10 strategies because you don't want to depend only on one source of income. I'm talking like watching and seeing trading, my trading performance and process as a business. Okay, so you want to diversify also the all of your income. If you see what I'm doing, okay, and I'm not even, I think I'm like 10% or of what the real quant developer, maybe 20%, let's say, of what the real quant developer, quant analysts are doing in hedge fund, in banks, investment fund, etc. Okay, yeah, that's why it's really hard to beat the market. And also seeing something like this, I think it could motivate you to and improve your overall performance. So basically analyzing my portfolio, my new portfolio, I I found out that my equity line, so the one you saw before, this one was the balance line, balance curve. So the same as this one. The problem is that balance and equity are two different line, okay? Two different things. And as you can see from this new, wait, yeah, this is, maybe let's zoom on this here because there was the biggest equity delta from the balance. So the blue line in this case is the balance line. The balance is the actual closed profit. The equity line is different, is like the highest or lowest point reached during the open position time. In this case, in the example I showed you, it was like 2,500. That's the highest equity peak. And so I found out that on my portfolio, in certain year, there were like this year here, there were like huge equity drawdown. Okay, but it's not the negative side. If you're trading with prop firm, etc., you don't really care about the this type of drawdown because this is like positive equity drawdown. What it means that your unrealized profit went up to, in this case, 8k. Here it says 11 and 300, but because from here to here is like other 3,000 euro loss. Okay, you just have to measure from this peak here of the balance to the to this peak of the equity. So this is like 8,000. I measured that, yeah, just to show you. So the prop firm, they don't care, they don't really care about this. But since I'm trading with Darwinex is like measuring your performance also with the equity, okay? Because if you are a real trader, here you made, of course, 8k and then lost 8k back and give the 8k back to the market. So that's not something good. And of course, I have to be that way, okay? Since I saw this, I decide, okay, let me think outside of the box. Let me think on this type of problem because, of course, like it wasn't all year. Even this year, in the beginning, you see the balance here, and then here, two big peaks of the equity, and then all of the two peaks went back to zero. Okay, even in drawdown, because there was like higher volatility, etc., etc., etc. So basically, after this type of analysis, I decide, okay, let me think and build something else, okay? And here it came out this type of analysis. It's called equity if scenario, okay? It's like a basic scenario analysis without any type of machine learning. And now the next thing I'm going to do is apply machine learning to this script here and analyze all of the different scenario like in a machine learning way. So I'm not going to do each test singularly, but like, of course, I'm going to let the algorithms work on his own. But just with this script here, I find out that here, let's say I modified the logics and put like a 2,500 equity TP. Okay, that's like very simple thing. So each time the equity line is reaching 2,500 euro, is going to trigger a take profit for all the position. Okay, it's like a bulk operation. It's called like that. So it means that it's going to close all of the position at the same time. Okay, wait, from here. Oh no, this one. Oh, okay. And here is the final result. So guys, this is a very small improvement, okay? Very small improvement that I did here. And as you can see from the final point here, you can see that my overall performance with the baseline, it was like 236,000. That is the same here, the same number, of course. With the first rule, okay, I'm closing the total years, okay, of report with actually 6,000 euro more, okay. But I don't really care about increasing profit. I can easily reduce the profit. I don't really care. Why? Because the goal is to improve the performance. And from here, you can easily see that the max drawdown, okay, it went from 11,500, okay, down to 5K. So it dropped like even more than 50% less. So that's awesome, okay? You can see from the drawdown analysis that the blue one was the previous one that you saw, and the green one is the new one. So the green one, it never went below 4,000, okay? So here it says 5,000, but I'm not that sure. But basically, also in this file here, the text file, you can see that, yeah, the overall performance, it went up, it increased. And yeah, basically, I did the same thing for each year. So it's printing each year performance, okay, compared together. And of course, like in some year, like in 2018, the performance was exactly the same, because in this case, this line here is the baseline, so the base strategy with no any type of risk management rule, and the blue one in this case is the improved one, okay. And basically this year was the same. 2019, I think, was even okay, no, was the same. I think a little less profit than 2020. 2020, wait, in 2020 was even way bigger, okay. So this one here is the new strategy, so it's like the portfolio plus the rule target at 2,500, okay. And this case was the baseline, so you can see a big gap, okay. 2021 probably the same. Okay, in 2021 the baseline did a better performance than mine, okay. But still, you have to think about that overall you increase the performance even if some year you did less profit, okay. 2022, little overperformance from the new rule than 2023. 2023, bigger performance, okay. And you think about that, you reduce the own equity, because this is the new rule, the green one that is stopped here, and this one was the old scenario, okay. So the baseline, yeah, this is like really nice to see that, like after a few hours of thinking about the script, thinking about how you can improve your own performance, you see something like this. So the overall equity drawdown, it went from minus 11,000 to minus 3,500. Okay, that's awesome. All the years are pretty much the same. In this case, baseline 2025, the same. 2026, now I could be in bigger profit because this is the baseline, this is the new rule. With this type of analysis, guys, you could really improve your overall trading performance. And of course, like this is, I think, 1% of what I'm going to do with this script and with this portfolio. Maybe 10%, let's say, because I just analyze this thing here. Now I'm gonna let machine learning to test each number from, let's say, 1,000 to 3,500, and then I'm going to analyze this second rule. Second rule is the global equity stop loss. So it's going to close all the position if the equity is touching something, some number, okay? And then, of course, I divide also the profit by asset. But then I think about, okay, wait, I have more strategy for each asset, so it doesn't make any sense. But I let it there just to try, okay? Then I decide, okay, let's see if I'm closing everything on Friday at 21 p.m. and let's test that. And then, okay, I divide everything by strategy name. So now I'm going to test strategy name target. Okay, and yeah, that's the process. I can show you an easy thing here. So if I'm going to turn this true and test it Friday at 21, closing all each trade open, you can see that in this case here in 2023, you can easily see that I'm going to increase my overall performance by doing a simple thing, okay, that I could never seen that coming, okay? Because like when you're testing 10 different strategies, each one on their own, okay, of course is way different to analyze and optimize them all together, okay? There is no such a tool on MT5, okay? Not either on the quant analyzer and all this software. So you have to build everything you need by your own. But you can see that in this case, in 2023, where we had the biggest equity peak drawdown, okay, so from the equity, from the balance, okay, this delta here. So you see that on the 2nd of June, we had some position open, and then on the 3rd of June, the portfolio opened way more position, okay, many more position, and then actually 3rd of June 2023 was Friday. So you see this is the weekend, of course, from the 3rd of June to till the 5th of June. But what if we close each position at 21 p.m., so 9 p.m.? It's around this number here. So this was like a big increase on the performance. Okay, so now we are just removing the equity target. Okay, we're just adding a new if scenario. Of course, it's like very simple. Closing everything at 9 p.m. on a Friday. In today's update, I'm going to show you how I'm applying the Holy Grail of Ray Dalio to my portfolio. So basically here you can see the video online on like YouTube, and like the logics behind this is the lower correlation you have between different income stream, but in this case income stream is from strategy. Let's say that each single algorithm's strategy is generating alpha. In this case, my portfolio has around 12 strategies, okay? And actually 11 strategies. Each single strategy, it made a certain amount, okay? And basically the logics is that you see each single strategy is it has like a return to drawdown ratio that is like different because of course it depends on the efficiency of the single algorithms and applied to that asset. In this case is like on the DAX, in this case is gold, 3 different strategies on gold, and those all are all of the return to drawdown ratio. And then logics that Ray Dalio is talking about is like the lower correlation you have between all of these type of algorithms that generate alpha, the higher is going to be the return to risk, okay? Because of course, if the correlation is low between all of those type of algorithms, it means also that each single algorithms is taking some type of trades not at the same time and same direction of the others, okay? Altogether, they're going to reduce the overall drawdown, but of course the aggregate profit is going to be exactly the same. So in this case, I was able to achieve a 72.6 return to drawdown ratio, and that's like really good. So basically, I don't want to keep my drawdown like this high. So the goal now is to reduce the risk for each single strategy, of course keeping the same return to drawdown ratio, because that's a simple factor, is dividing the total net profit by the biggest balanced drawdown, in this case this one. So basically I'm going to reduce the risk by keeping the same return to drawdown ratio. So that's my goal now. And yeah, basically everything I learned about how to increase your return to drawdown ratio is from Ray Dalio. So there is like a lot of video like this, and where he explained how this work. And basically I'm using right now Equalizer to build like the aggregate portfolio, but then I'm doing some of the analysis. Maybe I'm doing most of the real analysis on Python, because like you have like many option. Like in this case, I'm analyzing different if scenario. So this is like a little different from what I said before about correlation, but also I'm trying to analyze also the correlation part, because in this case here I'm analyzing the pyramiding. Okay, pyramiding, it means if a strategy is opening more than one trade at the same time, okay, this filter is going to try different scenarios. So if I put pyramiding max 1 per strategy, it means that it's going to open just one trade at a time, no 2, 3, 4 and more. Yeah. And also the same thing for each asset class. So if on gold one strategy is opening along and then like few minutes later another strategy, let's say in this case those are the strategy name. Let's say that gold ST and gold MR are opening like a long position in a few minutes of distance. This pyramiding tool, okay, is going to analyze, okay, let's say if only the first is opening the position, and then if something else on gold, same position, same direction, is opening also, I'm going to remove the second trade and let's see. So this is like reducing the overall correlation between each strategy. Okay, so I think it could improve the overall performance, and this is just analyzing on a back test. So the goal here is like to analyze first on the first, let's say, so the goal here is to analyze the first 4 years of period and then see how it performed on the last 3-4 years. Okay, so I'm trying to avoid overfitting, and then if something it showed results, okay, I'm gonna see all of the results here, like this maybe only 5 months or 6 months. Yeah, 6 months. This is like at the back. So when you start like a Python code that is like long, you want to try it only on a few months of period, so it's not taking ages. And in this case, like I'm running the full machine learning algorithm, full code on full backtest period, so 7 or 8 years. So it's taking a lot of time. In this case, I think it's like more than 1 hour. But yeah, it did many steps and it tried with a grid search different type of scenario. So yeah, I think it's like the best way to improve your overall performance. And last thing, because like you're going to see different update in the few updates I'm going to attach to this video. If you see something like this, that it seems like to be too good to be true, okay, yeah, maybe it is, but like you have to think about that this is like the old period, so it's 8 years altogether. And then if you actually zoom out on 1 year, like in this case this is 2025, actually is not that smooth. Okay, so this is like something real. If you had like a straight line up, I think that could be like a red flag, because like you cannot trust something that is like perfect. Okay, so you can see here that, okay, this is like the drawdown, equity drawdown, and it touched like minus 1,000 euro. I think I counted before, like a few minutes ago, I counted how many times. I think it touched at least 13 times minus 1,000 euro of equity drawdown. So actually it's not something insane, something super profitable, or maybe like crazy return, because actually like for 13 times you had 1,000 euro of profit, and then like in a few hours or maybe days you lost that for 13 times. And then for I think 3 or 4 times this drawdown reached the peak of minus 2,000, and for let's say 3-4 times minus 1,500. Okay, so yeah, that's just to explain that, okay, maybe it could be like a red flag here because it seems way too good. But then if it zoom in, like in a single month, in a single period, okay, that is gonna change. Of course, it's gonna change. So yeah, that's pretty much it for the beginning of this video. You're going to see in the next updates everything explained much better.